It is time for the Word on Wall Street. Top investors watching your money this week. Joining me today, Rosecliff Capital CEO and Managing Partner Mike Murphy, Stifel Chief Economist Lindsey Piegza, and Chief Investment Strategist Delos Capital Advisors Andrew Smith. Good morning to you all. Mike, let's go ahead and kick it off with you. Looking at the futures this morning, they are pointed to green on Wall Street after we saw that sell-off yesterday. Tech stocks were an issue yesterday. This is as we were watching the bond yields move higher, specifically on the 10-year. But Amazon, Apple, Netflix, Tesla, all closing with declines. Your outlook for the sector and what you expect to see. Is this choppy trade going to continue?
Good morning, Jackie. I think the choppy trade is here to stay for the time being. You know, the NASDAQ is really where the focus has been. The Dow hit a new high above 33,000 just 2 days ago. But really the tech sector, which has driven this market to new highs, the names you mentioned, the Apples, the Microsofts, the Amazons, that's where the money's been coming out of and rotating into other sectors like the banks. You see the big banks all hitting new highs. So I think really for investors, the question is the trade over? Do you take your profits and go home? Or is it something you stick with? And for me, it's a simple answer. I stick with big tech. That's where the innovation is. That's where the growth is. That's where I want to be. So although times like this, it's not pretty to see a 3% sell-off in a day, you have to stick with this winning trade. Okay. Lindsey, let's turn to you for a moment because this 10-year Treasury yield is troubling investors, pulling back a little bit after it topped that 1.7% mark yesterday. The highest level that we've seen it in more than a year. There was this notion that maybe we were stabilizing a little bit, and now that appears to have dissipated somewhat. Your reaction?
Well, I think investors are concerned about the Fed's somewhat nonchalant approach to inflation. It's very clear at this point that officials are not concerned about rising inflation pressures. In the near term, dismissing any kind of increase as temporary or a reflection of reflation, whereby lower lows in 2020 fall out of the annual calculation. So essentially returning us to previous price levels as opposed to an increase in momentum. And on the longer term, the Fed telling us they're still forecasting a very modest 2% level, so right in line with their target. So at this point, the Fed is not concerned, the market is, and until the Fed convinces investors of otherwise, we could continue to see this back up in rates carry into the second quarter.
Okay, investors will certainly be watching very closely for that. Andrew, over to you, because we're watching oil prices too. They're up $1 this morning, but it was after a sell-off yesterday of more than 7%, the biggest one-day drop since September. You can see futures are trading there at $60.46. Your reaction to the moves that we're seeing in oil in the broader context of what's happening in the market?
Yeah, so the headline risk came out that there was more inventory build than what originally was expected. We think a lot of that has to do more weather related. I'm being down in Dallas. We had the snowmageddon down here, so it shut down almost the entire state for an entire week. So we think a lot of that is transitory. Again, we're in the economic growth momentum. Month over month, gasoline prices are up 7.2%. So we know that the vaccine rollout is fueling economic growth. Borders are businesses reopening, and that allows for more oil consumption, especially as people start traveling again and using more leisure. So yesterday's blip in volatility was a buying opportunity for us.
Yeah, Mike, you know, we're also talking a lot about the consumer lately because consumer economic activity, it represents about 2/3 of the spending that we see in the overall country. You've got the stimulus checks being rolled out. There's some question about, are people going to go ahead and spend this money? Are they saving it? Are they paying down debt? And then you've got the higher gas prices. You know, so much to think about right now as the unemployment situation is still an issue too. You know, watching this recovery, as we call it, very closely. It's going slower in some places than anticipated. How long do you think it is before we get back to this normal sort of pace of life where people are spending, working, living the way that they used to?
Well, Jackie, you can call this what you want, but it's definitely not normal. You know, from stimulus checks that come out of the pandemic. So we don't go back to the old normal until the COVID pandemic is behind us. So people are getting stimulus checks. Some are going to invest that money in their Robinhood accounts. You know, you see the Reddit traders, cryptocurrency. Some people hopefully are going to pay down debt. A lot of people, though, are feeling better about their situation and are going to take that money, see it as free money, and go out and spend it. So, there's a lot of big retailers like Amazon, like Walmart, like Home Depot, where people are fixing up their homes. They're going to benefit from these stimulus checks. But hopefully this is the last round of stimulus needed, and we get the COVID pandemic behind us. We get back to an economy that really has a lot of upside, because there's a lot of technological innovation in this country. People want to get out of their homes. They want to get to work. So I think we put it behind us and the market can get back to its move higher.
All right. Lindsey, he just made the point that hopefully there won't be any more stimulus checks. We can put the pandemic behind us, and that we hope that's the case. At the same time, that spending seems to be a theme, whether it's on picking us up after the coronavirus pandemic or other projects as per the administration. And the spending frenzy doesn't seem to stop. Do you think that that will have a chilling effect on the markets and Wall Street, higher taxes potentially, that kind of thing?
Well, I think in the near term, the market is very much focused on this insatiable appetite for federal government spending, not only with the $1.9 trillion coming down the pipeline, but with the potential, as the Biden administration has indicated, of an additional $2 to $4 trillion for infrastructure, healthcare, other social agenda items. And so, of course, trillions in government spending will continue to boost the growth profile near term. But longer term, as we continue to see this massive expansion of the government's balance sheet, that will have to be eventually checked by either tax increases or spending cuts elsewhere, which will, of course, have a detrimental impact to the economy, trying to return to a more sustainable, organic method of activity.
Yeah, that makes a lot of sense. Mike Murphy, Lindsey Piegza, Andrew Smith, great to see you this morning. Thank you so much, folks.